All right, let's look at business tax credits. There's so many business tax credits that they actually lump them all into one category known as the general business tax credit. So there's actually something called the general business tax credit, and it's made up of several tax credits from many different incentives. And these incentives are given to businesses to either spend money on certain costs or to pay money as wages to certain targeted individuals. And if a business does this, they'll get a tax credit for it. So the first business tax credit that we're going to look at that falls under the category of the general business tax credit is the credit for family and medical leave. If an employer pays an employee for family leave, the credit is 12.5% of the wages paid to an employee who's on family leave, provided the employer is paying that employee at least 50% of that employee's normal wages. So employee says, I got to go out on family leave. If the employer steps up and pays at least 50% of that employee's normal wages, then the employer is going to get a tax credit for paying them while they're out on family leave. A maximum 25% credit is available instead of the 12.5% if the employer really steps up and pays full wages to an employee while out on family leave. How does a business qualify for the family and medical leave credit? All employees must receive at least 2 weeks of annual paid leave for family and medical reasons. The maximum credit is 25%, but remember you only get the 25% if the employer pays full wages to an employee while out on family leave. If they only pay at least 50%, then they get a 12.5% credit. So let's try. Connie works for Melvin Corp in the current year and earns $4,000 per month in gross wages. In June, Connie goes on family leave for 90 days and receives $2,000 per month while absent from work. If all other requirements are met, how much credit for family leave does Melvin Corp receive in the current year? So Connie's out on family leave, but she's receiving $2,000 per month, which is 50% of her regular $4,000 per month. Since Melvin Corp's paying her 50% of her salary, they qualify for a 12.5% credit. So it's 12.5% times $6,000 or $750 credit. And we multiply by 6,000 because she went out for 3 months, 90 days times the $2,000 per month. So 2,000 times 3 months is 6,000 times 12.5% is the 750 credit that Melvin Corp gets. Now Connie doesn't get any tax credit. Melvin Corp gets the tax credit. Connie continues to receive $2,000 a month. If Melvin Corp paid her full wages while she was out instead of just 50%, then they would have got a 25% tax credit, or $1,500. But because they gave her half of her salary, they qualify for the 12.5% credit. All right, let's try this. If an employer continues to pay an employee full salary while out on a 60-day family leave, the tax credit for the employer will be what percentage of wages paid? If the employer pays the employee full salary, then there's a 25% tax credit, which is letter B. All right, if an employer pays an employee for family leave, the tax credit for the employer is available provided the employer is paying that employee at least what percent of that employee's normal wage? And the answer is C, 50%. As long as the employer is paying 50% or more of the employee's wage, then the employer qualifies for the tax credit. In this case, it would be 12.5% credit as long as they're paying 50% of the employee's normal salary while the employee is out on family leave. All right, what type of business entities can qualify for the family and medical leave tax credit? A, sole proprietors and single member LLCs, yes. B, partnerships and S corporations, yes. C, corporations, all of the above. Letter D. The family and medical leave tax credit can be claimed by all business entities as part of the general business tax credit. And you'll see with all these general business tax credits, all businesses can qualify for these, whether you're a Schedule C, sole proprietor, or single member LLC, or you're a 1065 partnership or 1120S S Corp, or an 1120 C Corp. Any of these can qualify for the general business credit. And the Family and medical leave credit is part of the general business credit. All right, here's another one of the general business tax credits, the work opportunity credit. Companies get a credit for hiring employees from a certain target group and then paying them wages. Veterans, U.S. military veterans, are in that group, and so are the long-term unemployed. This credit, if taken, actually reduces the wages paid deduction. So not every business is going to find it necessary to take this credit, because if you take this credit, your business actually loses part of the wages deduction, which is strange and seems to defeat the purpose, but you do have to know that. If you take the work opportunity credit, there'll be a certain amount of wages deduction that's lost. So how do we calculate the work opportunity credit? Well, it's calculated on the amount of wages paid per eligible employee during the first year of employment. The maximum credit is $2,400 per employee, and that's based on 40% of the first $6,000 of wages paid per employee. So if $10,000 of wages is paid to a veteran of the U.S. military or to a member of a targeted low-income group, the maximum credit is $2,400. So 40% of the first $6,000 of wages paid, or $2,400, would be the business credit, what we call the work opportunity credit. Notice the whole $10,000 of wages is not going to qualify for the credit, only the first $6,000. So the answer is often $2,400 is the full credit if there's one employee. Any work opportunity tax credit would result in a reduction to the amount deducted for wages, and we mentioned that, and you could see that on the exam. So let's say wages for this business were $60,000 for everybody. If you had one employee that qualified for this credit based on the first $6,000 of wages, you would actually have to subtract $6,000 from that $60,000 of wages that you were going to deduct, because if you take the credit, the amount you use to calculate the credit gets subtracted from wages. Let's try this. Which of the following is correct regarding the work opportunity credit? A, cannot be claimed by sole proprietorships and single member LLCs. No, we just said that all these business credits can be claimed by all businesses. B, calculated as 100% of qualified wages with a maximum credit of $2,400. No, it's not 100% of qualified wages. It's 40% of qualified wages with a maximum credit of $2,400. C, based on wages paid to eligible employees and can be claimed every year if those same employees continue working. No, this is a credit for the first year. And this is an incentive to hire and pay certain individuals. But that credit is not repeated every year. D is the answer. It's calculated as 40% of qualified wages paid to employees in their first year with a maximum credit of $2,400. Let's go with letter D. All right, John was a U.S. military veteran hired by Trust Builders in the current year. Trust paid John $3,200 in wages. How much work opportunity credit would Trust Builders be eligible for this year? And we know that the work opportunity credit is 40% of qualified wages paid to employees in their first year with a maximum credit of $2,400. Since wages were $3,200, 40% of that is $1,280, which happens to be letter B. All right, there's a second credit for hiring certain targeted individuals, and that's the Empowerment Zone Employment Credit. So you got the work opportunity credit, that's for hiring certain individuals, and here's a second one for that, almost the same purpose. This credit is 20% of the first $15,000 of wages paid to the new employee, but the new employee has to be a resident of a designated empowerment zone. So it's based on where they live, what zip code, what part of town. And to get the credit, the employee has to perform substantially all services within the zone in the employer's trade or business. And just like the work opportunity credit, any empowerment zone credit taken would result in a reduction to the amount deducted for wages. All right, Jump Corp opens a restaurant inside a museum located in an empowerment zone in the city of Philadelphia. John Pat, a resident of that zone, is hired by Jump Corp to work in the restaurant and is paid $10,000 in wages for the year. Calculate the Empowerment Zone employment credit for Jump Corp. If you think you know the answer, let me know in the comments below. And then after you like and subscribe, Get yourself on I-75, the right road to passing REG.